Let's jump right in. Welcome to this explainer. Today, we're putting on our analyst hats to dig into a genuine valuation mystery happening right now in the European healthcare IT sector. We are going to unpack a massive private equity buyout offer for CompuGroup Medical, which is one of the top e-health companies out there. Our main goal here is to peel back the layers, look hard at the fundamental data, and figure out if the math on this takeover bid actually adds up. So grab a coffee because things are about to get really interesting. Picture this for a second. You're holding a stock, and a giant private equity firm knocks on your door offering you a 51% premium over recent market prices to buy your shares. Honestly, your first instinct is probably to take the money and run, right? I mean, it's a huge premium. But what if the experts crunched the fundamental data and told you that despite that shiny premium, you are actually getting lowballed? Well, that is exactly the dilemma facing shareholders of CompuGroup Medical right now. Let's look at why analysts are telling investors to hold the line. So, let's start by looking at the details of this takeover offer. The big headline number being thrown around is 22 euros. CVC Capital Partners, which is a massive global private equity player, has launched a voluntary takeover bid for CompuGroup Medical at 22 euros per share in cash. And if they pull this off, they plan to completely delist the company from the stock exchange. Now, on the surface, a 51% premium over the stock's 3-month average price sounds like an absolute dream exit strategy. But as we know in investing, context is literally everything. You have to look at the historical context here. CompuGroup's stock has been stuck in a really painful slump, totally underperforming the broader SDAX index. In fact, right before this offer came in, the stock took an absolute beating, including a brutal 32% drop on a single day back in July 2024. So for weary, battered retail investors, seeing a 51% premium at 22 euros probably feels like a life raft being thrown to them. But here is where the plot really thickens. While everyday retail investors are being offered 22 euros to just walk away, the founding Gotthard family, who currently control the company, are doing the exact opposite. They are supporting CVC's offer, sure, but they signed an agreement to retain a 50.1% majority stake in a new strategic partnership with CVC. So think about it. If the company's actually only worth 22 euros, why are the ultimate insiders fighting tooth and nail to keep majority control? It's a huge tell. It strongly hints that the family, and CVC for that matter, know the company's true long-term intrinsic value is much, much higher. Let's move on to the financial health check and look under the hood. When you look at the financial projections mapped out by MWB Research, you'll see that despite a somewhat sluggish start to 2024, the underlying business is undeniably growing. Total sales are projected to climb steadily, going from an estimated 1.16 billion euros in 2024 to over 1.22 billion by 2026. Guys, this isn't some dying legacy company being rescued from bankruptcy. It's a consistently growing tech company being scooped up on the cheap. Plus, their EBITDA margins are expected to expand back above 20% by 2026. And this right here, this is their absolute superpower. Roughly 70% of CompuGroup's revenue is recurring. They provide the core, mission-critical software that doctors, pharmacies, and hospitals rely on to operate every single day. You don't just switch that kind of software off. That massive base of recurring revenue generates incredibly reliable free cash flow. Just to give you an idea, in the first quarter of 2023 alone, they generated a staggering 79 million euros in free cash flow. That's exactly the kind of cash cow setup that makes private equity firms drool. On top of that, management recently reaffirmed their forward guidance. They're expecting organic revenue growth in the low to mid-single-digit percentage range through 2025 and 2026. And this growth isn't a fluke. It's being naturally driven by the massive, unstoppable macro trend of digitization across the healthcare sector. They are perfectly positioned in a market that literally has no choice but to modernize. All right, let's break down the SWOT analysis from the report. The analyst highlighted some incredibly defensive strengths for this business. Around 90% of CompuGroup's business is protected by sky-high barriers to entry. It is immensely difficult, almost impossible, for a startup to just walk in and replace deeply embedded healthcare IT systems. Now, of course, no investment is perfect. There are threats. The company relies a bit on ongoing political support for those healthcare digitization initiatives, and as an acquisitive company, they always face the risk of overpaying for or messing up the integration of new buyouts. But overall, this is a very well-defended fortress. Now for the fun part. Let's calculate the fair value. As analysts, we love a good discounted cash flow, or DCF model. It estimates the intrinsic value of a company based on its expected future cash flows. And what's wild is that the MDB analysts set a highly conservative baseline here. They forecasted a top-line revenue compound annual growth rate of just 2.3% between 2024 and 2031, and a very modest long-term terminal growth rate of just 2.0%. They aren't projecting explosive pie-in-the-sky tech growth. They are playing it super safe. And the results? Even with those highly conservative worst-case scenario estimates, the fundamental DCF model prices the stock at $24.32 per share. Let that sink in. That baseline conservative fundamental value is already noticeably higher than CVC's €22 buyout offer. On a purely intrinsic cash flow basis, the offer is simply way too low. Let's back this up by looking at a peer group comparison. When you benchmark CompuGroup against peers like Nemetschek, Atos Software, and Nexus, a glaring discrepancy pops right off the page. CompuGroup's enterprise value to EBITDA multiples for 2024 and 2025 are sitting way down at around 8 to 9 times. Meanwhile, the median for their peer group is hovering around 23 to 24 times. That means CompuGroup is trading at an incredibly steep discount compared to the rest of the sector, even though they have solid, comparable underlying gross margins. So, what happens if we assume CompuGroup should be valued at the same multiples as its peers? The math gets absolutely wild. Applying those comparable multiples gives us a massive fair value range for CompuGroup, stretching from €34.50 all the way up to an explosive €89.23 per share. Now, the analysts do note that this is just a supporting metric, since there are differences in company size and niche focus, but it brilliantly proves the main point. It shows just how deeply, deeply undervalued that €22 cash offer really is in the context of the broader software market. Which brings us to the final verdict. Based on their fundamental DCF valuation, the analysts have set an official target price of €27.50 per share. That represents a solid 27% upside from where the stock was trading and a full 25% upside from CVC's €22 offer. Because of this massive gap between price and value, MWB Research maintains a strong buy rating on the stock. And Harald Hoff, the lead author of the report, really doesn't mince words here. His definitive, bottom-line conclusion is this, quote, "We do not recommend, at this point in time, accepting the offer. The math is just too clear. The fact that the founding family is staying on board is the ultimate tell. The company is fundamentally intrinsically worth substantially more than what the private equity firm is trying to pay for it right now." So this leaves us with a really provocative final thought. It's the age-old market dilemma, isn't it? Do you accept the guaranteed, immediate premium of a quick cash exit, or do you hold the line, follow the fundamental math, and fight for the true intrinsic value of the business? We know for a fact that CVC and the Gothard family know exactly how valuable this company is. The real question is, do the rest of the shareholders? Thanks for joining me on this explainer, and as always, keep your eyes on the numbers.